Good morning and welcome. Patriot Radio News Hour. Joe and Jason on this Monday, the 19th day of June. Happy Juneteenth, the latest federal holiday. I think it started a couple of years ago. I think this was the day Texas, I think, was the last state to free the slaves. And so Juneteenth. Now a holiday, of course. Sunday, yesterday was Father's Day. Happy Father's Day. Jason, happy Father's Day. Happy belated Father's Day, I guess, to everybody out there. We had a great one. You know what? I'm not real big like my birthday, Father's Day, right? I want to do nothing. Like, what do you want to do? Let's get something to eat and lay around the house, maybe go to a movie. Like Sarah's like, what do you want to have for dinner? Like, well, I'll make a big dinner. I'm like, how about hamburgers and hot dogs, right? So that's kind of, it was, Jason, it was the perfect Father's Day. Joey, who's going to be with us here today, he called me early in the morning and we got to chat a little bit. And then these kids today, I will say this, my younger son, because I don't need anything, right? What are they really going to give me? I don't wear a tie to work. Maybe a hat to golf in or some golf balls, that kind of stuff. He actually, I don't know where they come up with this stuff, but there was I guess there's an app or, I don't know, some techie thing where he got a bunch of dancers, and I want to say somewhere, I think like a dance group of some sort, and it had said Happy Father's Day to me, right, Joe, Happy Father's Day, and then a funny word, I can't say it on the radio, but it was pretty funny, and then they held up like my picture. And we're doing this dance. It was pretty cool. I'd never seen anything like that. So, I got, it showed up in my email, or not my email, my text. It got texted to me and I watched it. I laughed like crazy. I thought it was great. How about you, Jason? You guys do anything?
Yeah, just did what the other fathers wanted to do. We got the dads of her dad and my dad sort of thing. With my dad, I just gave him a phone call. He does way more for me than most dads probably do. But did the phone call, did the ate lunch in a outdoor facility because the sun was out, so it wasn't raining, so that was nice. And I think the more comfortable a family is, the less celebrating you need to do. It seems like the more holidays we pile on, Joe, it seems like to make up for all of the lower standard of living. Right? It seems like the lower the standard of living, the more you got to celebrate what little you have. It seems like that's kind of where we're at in this country.
Yeah, absolutely. I think, you know what, you're probably some truth to that. Absolutely. It is Monday. I know the markets are closed for the holiday, but we have my son Joey with us from Northwestern Mutual, the best non-bank establishment, at least in my humble opinion, you could possibly have. And Joey, I want to tell you that late last week, Vanguard had come out and started saying, hey, here's what's going on. All these 401k balances, they're all heading lower. And Vanguard said with their active 401k balances, they're down 20+%. But it's actually more than that, right? Because all of these people are still contributing, because Vanguard says these are the active ones. The median 401k balance now down to $37,000. The average balance, $112,000. But it's amazing. More people, they don't know what to do in these 401ks. Maybe once a year there may be a meeting. They check a box, and then most people just forget about it. They know every paycheck some money's going into it, but they really don't know what to do. And this is one of the free services you offer. Anybody that reaches out to you, you'll actually look in their 401k plan for them and tell them, hey, you should be in here and here, because we know right now the market right now, it's AI driven, right? Anything AI is hot, everything else kind of not. Even the bond funds, especially the commercial real estate bond funds, have been terrible.
Yeah, we're seeing a lot of people's 401k accounts just being down 20%, 25%, and part of it's due to allocation and how we're invested in the market. And what I find for most older couples and older individuals and families is they haven't checked how their 401ks have been allocated for 5, 10, 15 years. And like you said, it's more of, hey, we set it up, forget it. And then once a year I see an account statement. And my team and I, we just come in, we ask for most recent statements, we review it, and give any suggestions on what we would do differently or what else we would utilize. When you bring up companies like Vanguard, well, Vanguard is going to sell primarily Vanguard funds. So we just want to make sure we're being properly diversified in our portfolios, and especially taking into account when our retirement age will happen. And for 10 years from retirement, 5 years from retirement, we're going to want to be off the roller coaster a bit and get into a safer portfolio. That way we're not seeing ourselves down 25, 20% when we're trying to retire and things like that. So I do emphasize, if you haven't taken a look at 401ks or you haven't had any advice from any outside opinions, my team and I would be more than happy to do so, and that's something.
We'll be back with more with Joey right after the break. Stay with us. We're back here, the Patriot Radio News Hour. Joe and Jason on this Monday. Once again, the markets are closed, but we have Joey with us from Northwestern Mutual, and a great place, obviously, with what's been going on in banking. The Federal Reserve taking a pause last week and saying that they need more time for more data to come in, and then Vanguard coming out and saying, hey, 401k portfolios continuing to lose ground. And Joey, this has been one of the things really for the last couple of years that you've been coming on. You've been telling the listeners, hey, let me help you. Let me check it out. I got a couple questions, though, for you. At what age, for people out there, because you talk a lot about taxes and being in that 401k all the way to the very end, and things that people need to be looking out for. When do they need to start being less risky? What are the ages when they really need to start looking at, hey, I need to be maybe a little less risky. I've already got a good chunk of money saved up. I don't want to lose it all. And then also, in correlation to that, what about preparing for taxes and things that they will do as they are getting ready to retire, things that they need to do within that 401k?
Yeah, that's a great question, and honestly, multiple answers. One, it depends on what are our goals, how are we tracking for retirement, but also, personally, how do you feel about market risk? Right? When we talk to people when they're 23, 25, we want them to take a lot of risk in these 401ks because they've got 40 years of experience. But when clients are entering their 40s, 50s, and 60s is when we want to start looking at these portfolios and make sure we're aligned correctly with how we feel personally on taking risks. The fact of the matter is you work your butt off for these dollars, and if you're someone that, hey, I don't want to ride that roller coaster, I'm certainly not okay with losing 20% in any given year, then we should have a conversation and make sure that we're being less aggressive with those dollars. But as we're 10 years entering retirement, it's very important we look at all the assets you have and accordingly adjust the risk we're taking. If we are solely relying on our 401k to retire, we need to make sure that we're invested correctly. We're not taking on too much risk in times like this, especially when the market is down. When the market starts to recover, we can certainly always turn up the heat but I do want to make sure that if we are solely relying on these 401k accounts, we don't really have too many other assets, we probably shouldn't be taking on too much risk with these dollars. Now, with that being said, if you have a ton of other assets that can grow for you in the short term and midterm, well, then we can take on more risk long term with these investments. But I think the most important thing when it comes to 401k contributions is the discipline of continuing to utilize it. I know the market is going down. When the market is going down, you're buying at a lower price. And when it does eventually recover, you will be reaping the rewards. And that might not be next year or 2 years. Maybe it's 3 years from now. But when we talk about investing in the market, you've got to take the emotion out of it. The disciplined investor always ends up winning. So I guess to answer your question in summary, 40s and 50s and 60s, and you haven't looked at those 401ks, we should have a conversation to make sure it's allocated the way it should be. And we're not taking too much risk in a market like this.
Let me ask you this. How about a guy that maybe, hey, they've done really well. They've climbed the corporate ladder, and maybe they've got $1 million or two in an IRA, or I'm sorry, in a 401k, but he's getting ready for retirement. What do you guys recommend them doing? Are there certain things that they would need to do, like rolling it into a certain IRA or things of that nature that will help them not get slammed with taxes?
Yeah, so for a person like that, we're looking at income tax brackets, and if it's traditional 401k, not a Roth 401k, what are some ways we can fund that into a backdoor Roth while we're still earning an income so that when we do retire, there's no income coming in the door, we've got those tax-free dollars, right? So we're being very strategic with that. And then also, we want to figure out, well, what amount of dollars are you trying to live off of in retirement? And based off of that, we'll decide, do we even need to take risk with these dollars anymore? Most people are actually tracking for their retirement with those size of accounts, and they don't need to take on the risk that they're currently taking. They'll talk to other advisors. They're like, we want more, put more in here. Whereas we're running actual math-based analysis, and if we don't need these gains anymore, we're going to find ways to restructure that to be more tax efficient via backdoor Roths. You look at things like the insurance side. Long-term care is a huge question for people when they enter retirement, and that's on average costing people $8,000 a month. We want to make sure while we are growing our wealth, we're covering ourselves on the defensive side of planning as well. And if you do have $1 million and you're managing it yourself and there's no one overseeing it, I think you should have us take a look at it and let us show you what we would do differently. The fact of the matter is people aren't doing what we're doing. 12 hours a day, we are constantly working, making sure that we're putting our clients in the right spot possible.
Joey, how do people reach out? How do they get a hold of you if they want whatever they want to talk about? But just, hey, I need an analysis. I want to know where I'm at, whether I'm 40, 50, 30, 65, or I'm going to retire next week. How do they get a hold of you so you can help them?
Yeah, reach me at my personal cell, which is 602-909-9048. Again, that is 602-909-9048. Just shoot me over a call. If I miss it, leave me a voicemail or send me a text message, and I'll get back to you as soon as I can. But I think that if people are curious or you're on the fence or you've listened to me come on for the past couple of years and you haven't reached out yet but you wanted to, I urge you to make that call now, because there are some things that we're doing over here that could greatly change your financial situation and outlook in retirement and give you that service that I believe everybody deserves. There's too many bad apples out there. Sorry, go ahead.
Good. Yeah, I was just wanting to ask you one last thing. Is when the Fed just paused last week? Where is Northwestern Mutual on Fed rate hikes. Do you guys think there's going to be one or two more hikes coming? I guess the technical, at least the TV version was, well, they're indicating that they may hike rates two more times between now and the end of the year. And so what do you guys think there? And what do you think the effect, if they did do it two more times, that would be on the banks and commercial real estate and housing, which housing, it's hanging in there, albeit at a super low level. But how high are interest rates going to be that are too high to make things work?
Yeah, I mean, honestly, time will tell, but we do believe there will continue to be interest rate hikes, right, which in my opinion will hurt the housing market a ton. I mean, people taking out mortgages, they're paying 7%. They continue to raise it. People are going to be paying 9%. Whereas 2021, you had a 2% interest rate or 3% interest rate. And when the market goes up, right, interest rates increase, it's not usually going to go well for the market. So we want to make sure, as we're looking at this, we're playing some defensive ball in the investment market. And when things recover, interest rates start to decline or die down or at least level off, we're taking advantage of that and restructuring our portfolios. But our outlook is, yes, that they're probably going to continue to raise rates throughout the year, making sure with our clients, one, we're educating them on that, but we're also putting them in different positions and restructuring things as we continue to go on and learn more from the Fed Reserve.
And a lot of people would say, hey, rates are going up. It's a great time to buy bonds. But that's not necessarily the case at all, is it? Especially depending on what type of bond.
Yeah, it depends on the bonds. If rates continue to go up, you'll be buying a bond today, you could have bought a bond later. The one thing I would say and suggest to everyone out there that's sitting on a ton of cash, because I know most KHC listeners are, is start utilizing a high-yield savings account. Utilize a money market account. These accounts are returning 4%, 4.5%. I know Northwestern Mutual is returning 4.7% in these accounts. In high interest rate markets, this is a great way to have your dollars work for you without taking on any risk and also bringing liquidity to the table. If you're sitting on 50 grand, 100 grand, 200 grand, $1 million, you name it, look into the high-yield savings account and take advantage of that from today's market. Get that 4.5%. It's not going to be there forever. When rates decline, that'll go down. But take advantage of things like that. There are small nuances that we can look to put our money into when there's markets like we see today.
Yeah, so you guys are at 4.7. So I know a lot of our listeners are doing that. They may only be getting 4%. Getting another 7/10 isn't a bad deal either. Joey, one last time, give them all your contact information because I know you got a meeting to get to.
Yep, reach out to me at my personal cell phone, which is 602-909-9048. Again, 602-909-9048. Just shoot me a phone call. If I don't answer, leave a voicemail or shoot me a text. But if you have questions, thoughts, concerns, or anything with your financial plan, please shoot me a call and let's have a conversation and see if we can help you out and be a resource for you at the end of the day.
There you are. Thanks, Joey. We'll talk to Joey again next week. But Jason, interesting when a company like Northwestern Mutual, they're in the Jason camp here. Hey, there's going to be more rate hikes coming, which is going to be more pain.
Yeah, I mean, I think rate hikes is pretty obvious at this point in history, which is if there's going to be inflation, there'll be rate hikes if it's going to get worse. And so if they're saying they have to raise rate hikes later this year, aren't they just saying that inflation is going to be worse later this year? That's the only thing. If inflation was gone, they would probably be talking about lowering rates. So it's plainly obvious to me, Joe, that they've seen the inflation thing before. It may be 40 years ago, 50 years ago, but they have a couple of models to look at. And usually you don't just get one spike of inflation and then just calmly goes away. You usually see a second spike, sometimes a third or a fourth spike. Sometimes you get a spike that just doesn't go away for a long time. and that means maybe worse than are we going to have a quarter point or a half point worth of rate hikes? How long are the rates going to stay here, and will they stay here permanently? A lot of people may be waiting and just completely miss the chance that, hey, yeah, maybe I could have afforded to buy that house or do some things financially in 2023, but I waited, and the rate stayed in the 5% range until 2025, and I lost 2 years of inflated money sitting there. Just like Joey said earlier, money sitting there in an inflative cycle is not a good thing. You can't have your money being eroded like it is at this point, Joe.
Yeah, and it is going to be really, really interesting, because that is the one thing I think the Fed has tried to make very clear is this higher for longer. Jay Powell talked about it again last week, his big statement, if you will, with their dot plot that I totally ripped on. Not one of the, I think it was 18 of them, not one of them forecasted a single rate cut for 2023. Not a single one of them. So it kind of tells you their thinking is rates are going to be higher for a lot longer than people think. Patriot Radio News Hour. We'll be back after the break.